Hopefully, knowing about the most common pitfalls can help you sidestep them, and your strategy should be a little more complex than let's make money. Ideally, we want to look for that Goldilocks, that sweet spot. It is far better to make a mistake with $500 than it is with $500,000. Hey guys, what's up? Welcome back to the channel. My name's Erin and this is Erin Talks Money. So glad to have you. So investing is growing in popularity, and at the forefront of this growth is millennials, those born between the years of 1981 all the way up to 96, so fairly large age gap there. And I myself am a millennial, and so are many of the viewers of this channel, so this is a very important group to me. The average person opens up their very first investment account at the age of 31. Well, that's pretty much smack dab in the middle of where millennials find themselves, because in 2020 they're going to be 24 all the way up to 39. Now, there's a few factors driving this growth and interest in investing for millennials. First and foremost, we have more apps than ever encouraging us to save and encouraging us to invest. Think about Acorns, which is a savings app, and then we've got things like Robinhood and Webull, which are investing apps. And then we have economic and financial news making headlines every single day because of all this economic turbulence going around because of Rona. And then also, beyond that, millennials are finally settling into careers rather than first-time low-paying jobs. So that means they actually have some spare cash to invest. So that's also driving the interest here. Now, I was very, very fortunate, and I grew up in a household where saving and investing were the absolute norm. It was talked about openly, and it was just expected that you would just one day do it. I bought my first stock at the age of 8. I opened up my first Roth IRA at the age of 17, and I have been an avid index fund investor for the past 15 years. So I have a long history with this. But I remember what it's like to be a beginner, and many of my friends are beginners. So I know getting started in investing can be scary. Starting anything can be scary because when we're a beginner, we tend to make a lot of mistakes, and investing's no different. But when it comes to beginning investing, it's mistakes with your money, so that can truly shake you up a little bit. Now, I wish our school system would teach people about investing and budgeting and finance, but right now, that's just not a reality. So we do have to go out and learn it on our own. But I wanna go over some of the most common pitfalls that I see a lot of investors make, a lot of newbie investors. I myself have made my share of these mistakes, but I wanna warn you about them so that hopefully you don't go out and make the same ones. I definitely wanna get you investing, but if we can help you avoid some of the mistakes along the way, that's even better. Before we dive right into it, please take 1 second just to hit the like button below. I appreciate it so much. Let's get to it. The number one financial mistake I see is people waiting to invest. You never hear someone say,
"Oh my gosh, I just started investing too soon in life and I just built up all this wealth and now I have no idea what to do with it."
Seriously, no one says that. However, you do hear people all the time saying, "I wish I would have started investing sooner because then I would have the money I need to live the life I want." In fact, not saving sooner is America's #1 financial regret. Time is the best thing you can have on your side to allow your money to grow. And once time is gone, there is no getting it back. Let's take a look at my favorite chart, which was put out by JP Morgan and Chase just a handful of years back, and it goes over 3 hypothetical people and the power of time and compound interest. So we have Chris, Susan, and Bill. Chris starts investing at the age of 25, invests $5,000 every year all the way to the age of 65, where he ends up investing $200,000 in total, and his returns turn him into a millionaire. He has $1.1 million, so not too shabby. Well, then we have Susan. She started investing at the same age of 25, invested $5,000 every single year, but only up to the age of 35. Then she stopped investing altogether, let her money continue growing, but never added another cent. She invested a total of $50,000, but compound interest did its work and time did its magic, and she ended up with $600,000. And then finally, we have belated Bill. Bill didn't start investing until the age of 35. He invests $5,000 every single year, all the way up until the age of 65. So in total, he invests $150,000. What does his net worth come out to at the end? Just over $500,000. So he ends up with far less than Susan, almost a whole $100,000. It's actually about $60,000 less than Susan. And he invested 3 times as much. But not investing in those beginning 10 years can hurt you so much. Once time is gone, you cannot get it back. Time is your friend. Start investing as soon as possible, and your money will do its magic. Don't wait too long to begin investing. Mistake number 2 is trying to time the market. The past several years were spent enjoying the longest running bull market in stock market history. Now, a bull market is when the stock market's going up. A bear market is when it's going down. And the past bull market ran on upwards for 11 years straight. The bull market officially came to an end in 2020, this year, with the spread of the virus going around globally. But prior to that, we had some really great years. And I would routinely hear people say, I want to get started investing in the stock market, but I'm going to wait. I don't want to go right now because every single month we're having the market hit new highs and it's the highest it's ever been. And who wants to invest when it's at the top? When it's up, it has to come down, right? Well, now the market has taken quite the tumble, and I still hear those same people saying, I don't want to invest yet, it's got to fall further, or I don't want to invest right now, the market is too volatile, I'm going to wait for things to settle down. Here's the thing, you can't predict what the market's going to do. You have no idea where the top of the market is, where the bottom of the market is. No one knows. I mean, in a perfect world, yes, you would get in the market when it is absolute bottom, and you would ride it all the way to the top. But here's the thing, no one knows where that is. No one. And if they say they do, they're lying. It's as simple as that. So rather than waiting for this perfect moment where the clouds part and everything says, get in now, just start investing. If you're forever waiting for this perfect moment, you're never going to invest, and then you're going to lose time and your money will not be put to work for you. Stop trying to time the market. Stop trying to wait for the most perfect moment to get in. The market will always be turbulent. No one knows what it's going to do in the short term, if it's going to go up or if it's going to go down. All you have to do is start investing. Long term, the market will go up. Number 3 mistake I see people commonly make is not understanding what they're investing in. When it comes to investing, you're putting your hard-earned dollars to work on an investment. I want you to understand what you are investing in. That's just common sense, right? So with the advent of apps like Robinhood and Webull, we're seeing more and more people get invested, which is absolutely great, and I am thrilled to see that. Robinhood has about 6 million users, Webull has about 10 million, and these apps are certainly targeted at millennials, with their average user for Robinhood being just 32 years old, or for the average user for Webull being 27 years old. So they're certainly millennial-based apps. And that's great that they're getting people invested. I truly love seeing anyone invest, but with it come a few concerns. A lot of people are buying individual stocks for individual companies without even knowing anything about the company. They're buying it because they like the stock ticker symbol, or they're buying it because their friend bought it and said it was a great deal, or perhaps they saw it talked about on the news, or maybe they simply just like the product of the company. These are not good enough reasons. When you are investing, you're buying a piece of a company. You want to make sure that you're making a sound investment. You would not want to go out and put your money into a company on the brink of bankruptcy, which is a potential. So you have to know the company you are investing in. Do your research, do your due diligence. And the same goes for all other investing styles. Think cryptocurrencies, investing in index funds, investing in real estate, investing in bonds. I have nothing against any of these investment vehicles. In fact, I think they're all great and they all have a place. But you have to understand what you are investing in. Know what you are putting your money into. When you make an investment, know why you chose this investment, why it is a good fit for you, why it's a good fit for your investment strategy. If you don't understand those things, you're just gambling with your hard-earned money and potentially just throwing it all away. Know what you are investing in. The next investing mistake I see is people being too conservative. Now, I get it. Investing can make you nervous, and if that's you, just know you're not alone. There are two ways you can be too conservative with your investments. One is not investing enough money, and two is not investing aggressively enough. Now, I know the stock market goes up and down in an unpredictable fashion in the short term. Yes, long term it goes up, but in the short term, it's anyone's guess. But watching your money take this roller coaster ride is enough to give anyone a panic attack. I get it. But having your money sit on the sidelines or sit in an interest-bearing account is not going to make you wealthy. You have to be investing. You have to accept some level of risk if your money is ever going to grow. Because currently, high-yield savings accounts are sitting at 1.25%. That is not going to make you wealthy. Inflation happens at a rate of about 2% per year. So even if you're sitting in a high yield savings, you're not beating inflation. Now, inflation sitting at 2% may not seem like a lot, but over time, it truly adds up. Let's look at a 40-year time horizon. So from 1980 to 2020. A dollar from 1980 is worth just 28 cents today. Said another way, if you bought a dollar's worth of goods in 1980, in 2020, you would need $3.11 to buy that same amount of goods. Inflation is a real concern. You cannot be so concerned with your money and so conservative that you don't save and allow it to grow. You have to put it to work. Sitting in a high yield savings account isn't going to cut it. You're actually going to lose money every single year simply because of inflation. You have to get investing in stocks in some manner. You don't have to be 100% aggressive, of course not, but you have to accept some level of risk because stocks return about 7 to 8%, so that's really going to help your money to grow. If you're just saving and letting your money sit there, you're never going to generate enough wealth that you're one day allowed to step away from your job and retire. You have to accept some level of risk. I know it's scary, but get educated about it and it'll become a little less scary as you begin to do so. Next mistake I see is people being too aggressive with their investing. Now, just as you can be too conservative, you can also be too aggressive. Ideally, we want to look for that Goldilocks, that sweet spot right in the middle. Because I have seen so many millennials get so excited about the idea of generating wealth and building money that they go all in. And when I say all in, they have nothing left in their emergency funds or in their short-term savings. You need an emergency fund. We all have emergencies in life. They come up at random times, often the most inopportune times, and you need money to handle them. Money for your emergency fund or for your short-term savings does not belong in the stock market. The stock market is simply too volatile and it's unpredictable in the short term to put any kind of money that you're going to need in the near term in it. What if you had your short-term savings for, say, a house or a car or a wedding and you put it in the stock market thinking you could make some money on it? But what if the market took a downturn and your money was cut in half or even worse? You couldn't get married or buy that house or buy the car. Any money that you need in the next 5 years, do not keep it in the stock market. It's just too volatile and unpredictable in the short term for that. Yes, in the long term, the market goes up. It's for investing, saving for your future for a long time horizon. Anything that you need in the short term, don't put it in the market, especially not your emergency fund, especially not your short-term savings. And the final mistake I see is not having a plan with your investments. When you invest, you want to have a strategy, and your strategy should be a little more complex than let's make money. I mean, that's a good one, but it should be a little more complex than that because you're basing your future on your investments. So to start with, figure out when you want to retire. Are you going to be retiring in 20 years, maybe 35, maybe 40? Figure out when your eventual retirement date is theoretically. You don't have to have the exact, it's going to be June 5th of 2050 50. It doesn't have to be like that, but pick a general year in which you want to retire. Maybe it's an age, and then you can work forward from there. Then you have to decide, are you going to live off your savings? As in, are you going to be living off the principal and the interest? Or perhaps you want to save the principal to pass on to your children and you just want to live off the interest. Well, that's going to affect how much savings you're going to have to do and how much money you're going to have to put away. And then next, figure out your risk tolerance and how much risk is acceptable to you and invest accordingly. Finally, you have to figure out how to make a diversified portfolio and balance it every year. And you got to do rebalancing annually. You invest so that one day you are no longer required to work, that you one day built up enough money that you're able to step away and live life on your own terms. That's a big undertaking. Approach it in a well thought out manner. Don't just leave your future to chance. This is going to take 30, 40 years to do, so it's okay to know that your plan is going to change and evolve with time. That's to be expected. All you can do is figure out a baseline plan for now and make sure that you're taking steps appropriately in the right direction for now. And then as your plan changes, you course correct and make new steps. But figure out a plan of action. Of course, your plan is going to change, but at least if you have a general idea, you can invest accordingly and in a well thought out manner and not leave your future to chance. Now, just remember, at some point, we are all beginners. No one is born knowing it all. We all have to take the time and figure it out. The more you practice investing, the better you're gonna get at it. And hopefully, knowing about the most common pitfalls can help you sidestep them and avoid making many of these common errors. The best thing you can do is just get started investing today. It is far better to make a mistake with $500 than it is with $500,000. So start investing when you have small amounts and you will learn along the way. You do not have to have it all figured out to begin investing. Trust me, as you begin, you're gonna figure out a lot along the way, and that's totally fine. That's how we all do it. So start today, get investing, and inevitably, you will build wealth. Yes, you're gonna make some mistakes, but that's okay. Make them early when you have small amounts to invest rather than large amounts of wealth. So I hope you guys got something out of this. Begin investing. It's the best thing you can do for your future. Your future self will certainly thank you. I post new videos every Monday and Friday. I look forward to seeing you. Please come back, like, subscribe, tell your friends about it. We've got a lot to talk about going forward. Have a great day. Love you guys. Bye.